Alright everybody, so today I'll just putting together a quick video about the markets. Basically, one of the things in David's book that you'll read, which is a critical piece of information, is springs, resolve, trading ranges, and upthrust, resolve, trading ranges. So what does that mean? In an uptrend, spring resolves trading ranges generally and leads to a high, like a higher high. And downtrends, upthrust, resolve trading ranges, and they lead to lower lows. That's why in uptrends we look for springs, and downtrends we look for upthrust. Right? So uptrend we look for springs, downtrend we look for upthrust. The other thing to note, which is not really, you don't find it that much in Wyckoff literature, is that upthrusts, either within the range or attempting to make a higher high on the rally, actually set up springs, meaning an upthrust in an uptrend sets up the spring. Again, upthrust in an uptrend sets up the spring. Upthrust in an uptrend sets up the spring. So when you see an upthrust in an uptrend, it gives you an idea that there's going to be a spring. Why does it do that? I think it's because they're probing the high, or there's a liquidity thing or whatever. But this is what happens. Because every time you make a little higher high, there's liquidity generated at the low. Every time there's a high, there's like liquidity generated at the low. And that liquidity, which is basically just stops, is very important to have, very important to accumulate, very important to go down there, accumulate low prices so you can sell at high prices. Every time this happens, for example, this upthrust, that means there's stops under here. Those stops can then be taken, buy low, and then bring them up, sell high. That's what's going on, right? So anyway, what I wanted to do was talk about what's going on in the market, because one of the important things that we saw in terms of selling was on 1220. On 1220, we saw very strong selling, all right? After that, the market went up and took out the 1220 high above that red bar, right above here, and it didn't follow through. It's just holding and hugging, and it sells off again. So this was the initial selling on 1220. After that, we had I don't know what this is. It looks like a trend, but it's like a counter trend. It's something that takes out this area and then falls back again. So there's sellers in this area. Otherwise, you wouldn't have these big red bars. Why I say that's important is because one of the most important indicators there are on the daily, especially on the daily, is market breadth. It is notorious for finding turns. So if you're looking at the daily charts and looking for daily trades, got to have an idea about the market breadth. Whichever breadth indicator you use, there's a bunch of them, but they will tell you. They're very good at telling you whether the stocks are participating in going up or down. And what happens is you don't really have all the stocks, go up or down at the same time. What happens is some stocks, then they get more stocks, then even more stocks go down in an uptrend. So these diversions are witnessed on the market breadth, and they're really important. So why I brought this up is I'm going to show you. You know how important the NASDAQ is, right? Making highs and all that. This is a market breadth indicator that I made. All right. So if you see on this 1220, you had, from that point on, you had a lot of selling. This is the biggest wave in 6 waves. By the way, it caught the low. Like when it was making lows, I don't know what the hell this is. It basically caught the low. I mean, I'm telling you guys, this shit is the best. See, when the market did this rally, around that time, there was buying. And this here was the biggest buying wave in 21 waves. After that, it made a higher low. Here it made like a slightly lower low, springing this entire area, and then boom, went crazy. But this move here on the whatever, this was telling me that it's coming, because we have strong buying and biggest buying in 21 waves, and then this higher low. And the S&P is making lower lows, but it's not going to work. It's not going to go down because the market's not participating. The same thing here. Now, after that entire trend, we're up here. But the thing is, in this move here on the 20th, you had a lot of selling. And once again, on this high, you don't have higher highs. You had lower highs. They're not participating. So then, but the way I do it is I'm not only taking a look at one exchange, because I want to see if I want them to confirm both NASDAQ and the NYSE. So I bring up the NYSE now, and this damn thing has the biggest selling in 29 waves. And lower high. This market that's making a higher high is not having the participation. Just like when it's making a lower low, here, it's not getting participation. So you want to see a couple of things. First, you want to see big buying waves in the market breadth. Then you want to see if those lows are making higher lows. While the market is making lower lows, there's a problem. It's initial buying down, a hell of a lot of buying, holding the low. Even though the market's making a lower low, the market's diverging. The stocks are not participating. Here, they're not participating. That's what leads to violent reversals. Here, market selling, that's initial selling. Market goes up, right? S&P, whatever, NASDAQ, but stocks are not participating. Same logic. So that's why you got to be careful, get ready for the pullback or the trend reversal. It's the same thing, and it happens over and over again. I mean, I can't even tell you how many times it catches the tops and bottoms. Here, that's selling whatever. This was this bullshit AI rally, and then it broke. So that's what's going to happen again. So that's what I'm looking for. So I'm looking at this wave. I know that this is the biggest in 49 waves. This is no ordinary selling. Then when it retests, this is the biggest in 10 waves, biggest. So something's up. Anyway, that's all I got. If you learned any lessons, just you want to see the structure of the market, right? The market structure is not higher lows. It's just not that simple. This is what you're taught. Really, the market, the way it works is you have a rally like this, rally, as you can see. And then you have a pullback. And then you have upthrust, which typically sets up the spring, which typically sets up the rally. And then you might have another upthrust, probe the high. Then you have a nice spring. Then you have the higher high, or sometime retest and whatever. But the point is, the market in a trend does not make higher highs, higher lows. It makes it makes a rally, and then it makes internal lower lows. Those internal, I don't even know what to call them, the pullback lower lows are setting up the next, they're springing to set up the next higher highs. That's the way, I mean, I'm showing you mechanically how it's happening. Look at this. Rally, lower low, spring, boom. Rally, lower low, rally, higher high. Here again. When the market starts trending, this is what it does. Rally, pull back, rally, low, up thrust, spring, makes the lower low. That sets up the higher high. Pull back, up thrust, lower low, spring, that sets up the higher high. Higher high rally, lower low, spring, that sets it up. It's like the lower low is setting up the higher high. The lower low is setting up the higher high. Now you can say, what is a lower low? It's an internal downtrend or whatever you want to call it. But that's the way it works. All right, so it's definitely not the traditional higher high, higher low, higher high, higher low. That's not the case. Anyway, you can try for yourself and you see that this is the situation. Take care, bye.